You buy Bitcoin, you hold it for more than 4 years, Joe. That's my advice to everybody.
Fair to say you simply flooded the system with money.
Yes, we did. That's another way to think about it.
Where does it come from? Do you just print it?
We print it digitally.
I'm very bullish on the long-term viability of Bitcoin.
I was going to say, did that surprise you?
That surprised me how much that's gone up.
Hey, Internet. Welcome to another episode of New Foundations, the podcast brought to you by Acropolis, the Bitcoin Treasury platform. And joining us today is Himanshu Sahay. He is the co-founder and CTO at Arch, which is a Bitcoin-backed lending platform, or I should say a crypto-backed lending platform, because they do provide other forms of collateral. And also, Arch is the official lending partner to Acropolis clients. So Himanshu, it's great to get you on today. Just to give listeners a little bit of context of what we're going to dive into, I kind of want this to become the Bitcoin-backed loans masterclass. So we're going to touch on 4 different segments. It's going to be Bitcoin as pristine collateral, how these lending facilities work, kind of the behind the scenes that you can demystify for us at a lending platform like Arch, your market outlook, trends, things that have you excited in the space. And then we'll round it out with Bitcoin-backed loans for businesses and kind of the corporate treasury use cases. So Himanshu, thanks so much for being here.
Thanks for having me. Excited to jump in today.
Cool. So let's start, like I said, with Bitcoin as pristine collateral. This is a phrase that has been popularized in the Bitcoin community. What does that mean to you? Somebody sitting in your seat, can you kind of explain how Bitcoin is different in terms of collateral for a loan? And is it really pristine collateral?
As a lender, it's probably as pristine of collateral as can get. And let me explain. So as a lender, the collateral you have, you want to be able to predict certain things about it, and you want to be able to make sure that you can get out of a position when you need to. Let me break it down further. So as we know, there's only ever going to be 21 million Bitcoin. So it's predictable. It cannot be debased or inflated away. The value of your collateral will not change from a Bitcoin perspective. And you can track it from a dollar perspective. In the past, or even today, you can borrow against your stock portfolio, right? But that stock portfolio trades between certain hours in a day. It can be halted in certain assets. And you could wake up when the market opens and you might be underwater on your position. Bitcoin trades 24/7, 365, cannot be stopped. There's a high amount of volume and spreads are quite tight on trades. So you can very predictably make certain LTV decisions and make sure that you as a lender can get out of a position if you need to. The third thing, settlement in Bitcoin is final and it's irreversible. When you pay someone with, like, say, an ACH a transaction for fiat, that has a period in which it can be clawed back and it can be reversed. Now, as a lender, that would put you at a significant disadvantage, which is why actually for our final payment, we don't allow ACH, we allow wires or USDC only, because that from a borrower, from the sender's perspective, can be reversed. Bitcoin, on the other hand, you can move across borders without an intermediary anywhere in the world in minutes. There's no counterparty with Bitcoin. We're not dealing with someone who can go change something about Bitcoin, maybe block us from holding it, or block the borrower from holding it. It's very transparent as a result too. You can, especially today, can do audits and verifications on chain to check the source of funds, make sure that the Bitcoin we're getting is clean and is not from an OFAC sanctioned counterparty, for example. And as we think of being a lender globally, Bitcoin isn't tied to a nation. It's not tied to any jurisdiction. It's essentially a neutral settlement asset, which is why now so many big banks that operate globally, so many institutions that want to operate globally, and so many sovereigns are adopting Bitcoin as an asset, as a reserve asset, because it truly is that perfect, globally neutral, transferable, verifiable asset.
So maybe to take a step back, if Bitcoin is a great form of pristine collateral because you can liquidate it 24/7 with a global market, no counterparty, maybe for folks who are really only learning about collateral and lending products through the Bitcoin lens, let's explain something like borrowing against your real estate property or some other asset. Can you explain kind of the lengthy process to try to liquidate some of the hangups and headaches that would come from another form of collateral?
Absolutely. So let's say I'm a mortgage lender, right? And I've given you a loan against your house. You don't pay me for, let's say, 2 3 months straight. We're not able to collect from you. We now have to foreclose on your property, run a public auction, sell that property. We don't know at what price that would sell. So let's say you are going to have a 5% range in which you can sell and still make a profit, but the market goes down. We're in Detroit, circa the decline, and the property doesn't sell, or it sells for pennies on the dollar. Now, as a lender, you've made a loss. Most lenders have a default rate baked into their cost of capital and or into that math. With us, the default rate is expected to be zero always because one, we do over-collateralized loans. So if you have in dollar value $1 million in Bitcoin, we'll lend you up to $600,000 in cash against it. At 70% LTV, LTV is loan to value, there's a margin call in which you have 24 hours to either put up some more collateral to bring it back to 60 or add some principal to again bring the LTV down 60%. And then in practice, I will say we do work with our clients. Our approach is very handheld white glove customer service. So if you need some more time and we're able to manage that, we will make every effort to make that happen for you. At 80% LTV, there is a partial liquidation, which means we'll liquidate some collateral to bring you back to 60%. So in a traditional loan, if you default, that's it. The loan is done. With us. Because Bitcoin is so easy to liquidate, to manage, even if there is an event of default, we'll just liquidate a little bit to bring you back to a healthy loan and let you continue. Because, like in the real world, if you have a foreclosure on a house, like your life could get turned upside down. With us, we can manage that collateral, bring you back to healthy, and let you continue.
Right. And the reason that these crypto-backed or Bitcoin-backed loans need to be over-collateralized is because of the volatility, right?
Well, yeah, so that's one reason, but also because keep in mind, these loans are not based on your credit. These are just asset-backed loans. So we don't care what your credit score is, what your debt to income ratio is, as long as you have no other liens on this asset. And the way we prove that is by you sending the asset to us in insured qualified custody, where we keep it, we don't touch it. It just sits there. It's almost like an escrow in the real world. But it sits there, so you cannot take another loan against it, and so that it's easy for us to manage that LTV premium. But yeah, I think over time, as we figure out how to combine credit and asset risk here, these products will evolve. I think today where we are is it's purely an asset-backed loan, which is why it's over-collateralized.
Okay. And we're talking kind of about Bitcoin-backed loans right now, but Arch does lending against other forms of collateral, other crypto tokens. Is it fair to say that crypto tokens are pristine collateral, or is Bitcoin somehow treated differently in your facility compared to other forms of tokens?
Bitcoin is very much treated a bit differently. So I can talk about this a bit later, but we have a traditional financial like debt facility. It's called a collateralized loan obligation. Um, that has certain caps on other assets, and that's purely because of liquidity reasons, or if you can go print more of an asset, which I mean, we have in addition to Bitcoin, we have Ethereum and Sol, but we do have caps on how much of the book can be those. I will say in practice, 80%, 85% plus is usually Bitcoin, and we do understand that a lot of our clients may hold other assets as well. So you often find someone that has a Bitcoin backed loan, but then they may open a Sol backed or ETH backed loan as well. our community is very much Bitcoin focused.
Right. And this next one is a question that we get all the time. And I have my version of an answer to it, but I'd love to hear your answer, which is, okay, if Bitcoin is pristine collateral, then how come borrowing rates are still so high compared to these other forms of inferior collateral that you could be borrowing against?
Absolutely. So Bitcoin is pristine collateral to you and I, but think of where the capital to lend the money comes from, right? It comes from traditional finance, which has been slow to adopt this industry. Um, we've had Bitcoin for, in the grand scheme of things, not that long. It's been about 16 years now. Um, and it really started becoming more mainstream with the first wave of lenders, let's call it from like 2018 to 2022. And they all failed in 2022. That was a big setback for the industry because a lot of people providing their capital were now scared to do that again because they didn't understand fully what happened. We know what happened. It was bad risk management, rehypothecation, which we strictly don't do. Not a good way of managing a book, especially on something that is new and unique. So now, when we raise capital for Bitcoin backed loans, we have a cost of capital that we pay, and then we take a small spread on top of that for our services, and then we lend it out. I will say the rates have been coming down consistently. A year ago, I think the market was around 15, 16%. Today, the market is, depending on the loan size and a few other parameters, in the 10 to 12% range. And I expect this to continue to drop. Like I would fully expect to see single digits by sometime next year. So as the lenders into these facilities get more comfortable with the collateral and get more comfortable understanding the risks, we also were in a different regulatory environment up till late last year when uh, banks and traditional finance were just not comfortable entering the space, at least in a meaningful way, and attach a risk premium to their cost of capital to us. That is changing, and which is why our cost has come down consistently over the year, and that's going to continue to come down. Another factor is just the rate environment we're in. SOFR is the funding rate that people typically use for these facilities and for a lot of different forms of debt, and it sits at like four and change right now. So the cost that we get is going to be always a spread on top of that, and then we have to charge a small spread, and then the customer gets the final rate, right? So if you're borrowing or if you're doing a mortgage today, mortgages can be between like 6 and 8%, and that depends on how creditworthy you are. We're not that much higher than that, and the collateral you have here is increasing in value consistently. The CAGR on Bitcoin in the last 5 years is I think 62%. So even if you're borrowing at 10 or 11 or 12%, the asset you have using it as collateral is growing at a much higher rate. So you actually end up doing pretty well on the loan itself.
Okay, and I guess it's somewhat implied in the phrase Bitcoin is pristine collateral that sooner or later Bitcoin loans should have the lowest borrowing rates. Would you agree that on a long enough timeline that that's the case?
They will, but they'll never be below the funding rate, right? So all money is printed and provided to the initial banks that can then lend it out further at a certain funding rate. Now, no one is going to lend to you below that rate and lose money. So it's always going to be if the funding rate is 4.25%, the cost for a Bitcoin loan will always be higher than 4.25%. Now, there are probably other ways to get um, that down cheaper, but if you think of how money flows, like what is considered the safest form of getting yield today on your cash is to put it in treasuries, and that's where you get the 4.25%. Um, Over time, that might change where we have other forms of getting yield. But if these loans are going to be denominated in dollars and you're taking funds in dollars, then that is the cost today. There are other countries where these rates can be cheaper. And I think we might see some arbitrage in the future in those countries with using their currencies. But this is where we are today.
Yeah, that makes sense. Okay, and if a family member of yours was using Arch and you could kind of guide them on what LTV, what loan to value ratio
Mm-hmm.
you feel comfortable with for a family member, how would you kind of think through and talk them through that?
It's a good question. It's so dependent on your personal financial use cases, and let's use an example, right? So let's say you have a large amount of Bitcoin. You want to now use a small percentage of it to get a loan. By all means, go to 60%. You know that when there is a margin call, you can meet it, no problem. A margin call is not a bad thing. A margin call is a function of the market moving. So people often get scared, oh, I'm going to get a margin call. That's fine. Almost all of our customers meet their margin calls in time because they have other assets that they're able to use to meet their margin call, or they can pay down some principal. So it's never really been an issue. Now, if you're using your full Bitcoin stack, first off, I would never recommend that. I would always recommend using a bit less than that. And if it is going to be a significant strain on your finances, definitely take a lower LTV. We work with one of your partner companies, OnRamp, and we recommend 50% LTV in those loans. We also have another product which is it's called perpetual income, which is more for it's for the retirement use case. On that, we let you keep your loan running and doubling each year. There we recommend 20%. So it really depends on your use case and how much you want to, how long you want to borrow for. Do you have other income or other assets you can pay your interest with? Will you meet a margin call when it happens? Is it going to be a significant strain on your finances? If it is, don't do it. You should never take on additional debt to add more strain. You should do it in a smart way. I think Bitcoin-backed loans are a very smart way of taking on debt if you can afford it. I wouldn't recommend doing it if you can't.
And I think it's worth spending another moment there because I think when people hear margin call, they've seen the movie Margin Call, maybe they think that that means liquidated. So I think it'd be worth you spending just another moment there to explain, no, the margin call is really just Arch reaching out to the client and saying, hey, we're getting at a certain LTV ratio where, the loan is looking risky. We'd like you to basically top up your collateral so that we don't end up having to liquidate it. So can you maybe just kind of tease out liquidation versus margin call in the order of operations?
Actually, an interesting situation there is with the volatility. There might even be a situation where your margin call is cured itself by the
Right.
Bitcoin price movement, so you don't even have to do anything, and that has happened many times.
But there's also the scenario where your margin call gets blown right through to liquidation, right?
Yeah, that's true. And if that does happen, we're not closing your loan out. In the
Okay.
past, lenders would fully close your loan. I think there are still some that would do that. We will just liquidate a little bit to bring you back to 60%. The goal is to never have you lose your Bitcoin. There are ways to solve this with making it a loan that's a sliding scale. So our loans function like lines of credit, right? So you start at certain LTV, there's a margin call. If there's partial liquidation, we'll sell some, bring you back. But if Bitcoin is going up in value, you can just take some Bitcoin out or withdraw more against that same loan. So to explain a margin call situation, let's say your LTV gets to 70%, you get a notification from us, and then someone on the team will give you a call as well to make sure that, especially if you haven't met it in about 12 hours, you'll get a call, and we'll ask you, hey, what's your situation? Are you able to meet this? If you need another day, we'll try to work with you on that. The goal is to just make sure that you have some Bitcoin that you can transfer in a reasonable amount of time to get back to 60%. And if it does get down to 80%, it's a fair transaction that you have to get some amount liquidated to get back to 60.
Right. And you kind of mentioned this earlier. If you post Bitcoin as collateral and you take out a loan, but then Bitcoin's price appreciates, theoretically, and I have a loan with Arch personally. So Arch reaches out to me and says, hey, you're now, over collateralized. Would you like to borrow more dollars? So can you maybe just kind of explain that a little bit?
Yeah, it's actually so easy. You can go in your platform, in your Arch dashboard. It's one click, and you can borrow up to 60% again. So the goal with so if you think of Bitcoin as pristine collateral, and it's something that's liquid, you can mark to market basically every second, right? You can provide something more flexible than a traditional term loan to borrowers. If you borrowed at Bitcoin 80,000 and Bitcoin's now at 100,000, um, and I guess today it's like 110, you should be able to extract the additional value of your Bitcoin loan. In the past, loan terms were very short, up to 1 year. Our loan terms are longer. We go up to 2 years, and we let you keep rolling over your loan beyond that in perpetuity. As a result, you should be able to extract the additional value you've gotten from your collateral, which is constantly appreciating. So you don't have to pay back your loan for no reason. You can keep continuing to get that value. It's an interest-only loan, so your capital that you're paying towards your interest is very small per month. You're not paying the principal down. So if Bitcoin goes to 50% LTV or below, you can, in one click, go in the dashboard, click the upsize button, choose how much you want to borrow. You can borrow up to 60% again, and then that's dispersed to you within minutes. If your loan is ending and you want to continue with that loan, just go in the dashboard, click the rollover button, and you can continue doing it. The goal with using Arch is we provide a high level of customer service, but that supplements a very good UX, which is very easy to use. So anything you need to do is in the dashboard, it's within 1 or 2 clicks, and it's very transparent on what the different prices are, where you're going to get margin called. Everything's written before you ever send us any collateral.
It's a very easy to use product. It's really a wonderful UX UI. So you mentioned $80,000 there, right? In my use case, I watched Bitcoin drop, what was it, a few months back, where we tapped 79,000. And I said, okay, this is a great moment for me to post Bitcoin as collateral with Arch and borrow against take on my dollar loan. I'm curious, is a moment like that, like a drawback, does that see increased demand at Arch? I know a lot of folks, when they talk about doing Bitcoin-backed loans, they talk about try to do it at the lower band of like the 250-day moving average, because again, you really don't want to have to deal with a margin call or liquidation risk. You really want to try to borrow when you think you're at the lower end of the band. So I'm curious if you also see demand for the product increase during those moments.
So I think there's different use cases. We have some people who are more risk averse and want to be smarter about timing when they start the loan so that they have lower margin call risk. There are others that want to extract the max amount of capital out, so they'll typically go on the higher end. Our numbers, and I think this is true across lenders, you actually see more borrowing demand when the market's up. It contracts a little bit when the market is down. So if I were to borrow personally, and my use case is not going to buy more Bitcoin, but maybe investing in a property or refinancing some other debt or whatever else the use case would be, I would probably follow your example, Chase, and do it when the market has dipped. But I would say most people are looking to just extract the max value, and they will typically increase in that behavior as Bitcoin appreciates. And you also see a lot of people that have loans open when Bitcoin's down will just go upsize the loan when they're able to when Bitcoin's up.
Yeah, that makes sense too. If you're maximizing for the dollars you can pull out. Yeah. Okay.
And again, it touches on what we said earlier. These people are comfortable doing it because they know that when there is a margin call, they'll be able to meet it because they have other Bitcoin they can use.
Exactly. Yeah, as long as you're not borrowing against your entire stack, then you can always meet that margin call. Okay, so for the dollar liquidity side of the facility, this to me reminds me of people who say, why would I buy a Bitcoin equity like strategy? If I believed in Bitcoin, I would just buy Bitcoin. So let me ask you, and again, this is another one of those things where our clients ask us all the time, and I have my answer, but trying to steal best language from you here. Why would somebody lend dollars to an over-collateralized Bitcoin loan if they could use those dollars to just buy Bitcoin and capture the full upside themselves? Don't you kind of have to believe that Bitcoin's not going to zero and that Bitcoin is a real valuable store of value asset if you're going to lend your dollars against it?
Every business will hold Bitcoin. Some already do, others are developing a plan. Acropolis is how smart companies take action today. Built on multi-institution custody, Acropolis delivers a turnkey Bitcoin Treasury solution designed specifically for businesses. Here's why that matters. Multi-institution custody is the breakthrough that unlocks the corporate adoption of Bitcoin. It eliminates the need for employees to hold private keys and removes reliance on any single custodian. Instead, Bitcoin is secured using a 2 of 3 multi-signature quorum, where each key is held by a separate, regulated institution. No single party can move funds on their own, eliminating single points of failure and greatly reducing risk. We act as an extension of your Treasury team, managing institutional-grade custody, insurance, continuity planning, and strategic advisory, so your company can adopt Bitcoin confidently and securely. If your company has been sitting on the sidelines, unsure of how to get started, or worried about getting it wrong, this is your signal to reach out. Visit acropolistreasury.com and schedule a consultation with our team. Bitcoin is reshaping corporate finance. Don't get left behind.
Let me pose the question to you instead. It's not going to be about Bitcoin. So why would someone lend money into a facility to help people buy houses when they can just go buy the house themselves?
Okay. The
How do you-
answer there being, I guess, that they're outsourcing the specific risk to the individual. They maybe don't want to own the house, they just want yield.
That's it. So there's a big trend in the last 5 years has been, especially with the rates increasing, has been the rise of private credit, where there's a lot of different ways to get yield on dollars, which are beyond the federal funding rate, right? So that has really increased appetite, and that industry has done really well in the past few years in just lending into different situations. Now, Bitcoin-backed loans are one of the safest buckets in which they lend, and which is why they make much less on Bitcoin-backed loans than a lot of other industries where you can make high teens, even over 20%. Even in real estate, you can make 16, 17% lending into distressed real estate, especially in construction. With Bitcoin-backed loans, those rates are actually contracting. But if you look at, if you have, say, $1 billion book you want to lend out to different industries, you want to have a high risk bucket, a low risk bucket, and Bitcoin-backed loans, which may have been in the high risk bucket 2-3 years ago, are now in the low risk bucket, and they know they'll get that yield stably, and they'll continue to do it, which is why there's been an explosion of companies or financial institutions lending into Bitcoin-backed loans. And it's not just been with us. I think a few other lenders have done it too, and I think it's only going to increase. And I think it's fantastic for the industry because credit as a component of the Bitcoin asset class is still very small, but it needs to increase so that people have more utility from the Bitcoin they're purchasing or they're holding. Otherwise, you hold Bitcoin, you don't want to sell, so what do you do with it? You have to extract that value somehow, right? It's not just something that you look at on your at your custodian or your wallet and then smile at night. You have to extract some value from it, and this is how you extract value from it. It's a very simple transaction, in my opinion. As we think of where lenders decide that rate, so I think we spoke about this earlier, right? Like that risk premium is coming down. The next step for our facility is going to be to get it rated and securitized. When we do that, I fully expect this to be a AAA rated facility.
Yeah, that's kind of the other way to answer the question is why would somebody lend dollars to over-collateralized Bitcoin loans? It's like, well, if you understand that this is pristine collateral, then it's almost like there's an arbitrage because the risk rate, that interest rate, is not actually being priced correctly momentarily, and you can get a higher yield for what is actually much less risk than many other ways that you could be lending dollars. And one of the yeah, go ahead.
No, go on.
I was just going to say one of the main use cases that we see for this is when we come in and work with a company, we take a comprehensive look at their existing corporate treasury. And obviously, you know, the capital that they can park in Bitcoin for a 4 to 5 year period, we want as much of that in deep cold storage Bitcoin as possible. But a lot of the companies do have operational needs, seasonal expenses, unpredictable overhead at times, and they need to have some level of dollar liquidity. And so we say, look, you're already a believer in Bitcoin. Bitcoin. We've maxed out your deep cold storage position without jeopardizing the operating business. But this dollar liquidity, instead of using money market funds or T-bills, you can actually be the dollar lending side of these facilities and get a higher yield. And you know that you're not actually taking additional risk to get that higher yield. So we are basically Bitcoinizing their entire balance sheet, not only the Bitcoin portion, but also the dollar liquidity side.
Absolutely. I think this is why the rise of Bitcoin treasury companies is so interesting, because in the past, you build companies on an asset base of dollars or some other hard assets. Um, Now you're building a company on an asset base of Bitcoin, which can then let you extract so much more value in terms of dollars from that Bitcoin, which is constantly appreciating when the dollars are actually depreciating like year on year.
Yeah. So has Arch ever thought about building kind of a buy, borrow, die strategy out of the box? This is something that we hear a lot about, which is the idea that, yes, you never want to sell your Bitcoin, so you borrow against your Bitcoin. But, you kind of, in traditional assets or dynastic family wealth, they borrow, 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 let the asset keep appreciating faster than the interest rate, and then they die. And that's kind of the strategy as they
And then
pass the asset down to the next generations. It feels like something that could be productized and that you're almost already halfway built.
we have, yes, so we have already prioritized it. We work with someone called Mark Moss, who's a Bitcoin educator. I'm sure a lot of people listening today would have heard him. So we've partnered with him to launch products for specific niche use cases, right? So we have a foundation of lending, which works really well. And now we want to go to people to add their use case where they are. So you might be someone that doesn't actively have an income, that wants to just borrow against your Bitcoin stack and let that run for the rest of your life. So we call that product perpetual income. And it's exactly what you just described. You have your asset, you put it at Arch, it sits in qualified custody, you can always track where it is, and you get tax-free income in the form of the loan every year. But as Bitcoin is appreciating, you're actually able to keep withdrawing more and more each year. So that's the one product there. We're actually doing a few more. We're doing one which we're launching soon, which is going to be a tax incentivized investment product, also enabled by lending. And we're going to go to different customers at their use case, try to understand exactly what do you need, how can we solve that with the asset that you have, and really being more of a private bank in that realm. I love that you said buy, borrow, die. In the world of private banking, that's how life works. You never ever sell your assets. And that's what we always wanted to build when we started the company. And that's been the ethos with building our product, which is why you can keep upsizing, you can keep rolling over, you can have your loan open with Arch for life, and it will continue. And then we also have, you can set your beneficiaries and such. So if something does happen untoward, like your beneficiaries will get that asset safely. And I know you guys do the same thing with MIC. You should never sell your Bitcoin. I think we all agree on that. And keep borrowing against it. Keep enabling your life, your investments, anything else that you need, and your collateral will keep increasing in value.
And in that case, and I'll have to look at this product because I didn't know that you guys were providing that. In that case, when the name on the loan does decease, does the loan itself get passed to the next generation, the next of kin, or does the Bitcoin have to be sold off to a certain extent to pay off the outstanding principal and interest before handing the Bitcoin over to the next generation?
Yeah, so I'll be honest with you, I don't have the exact answer right now. I'll have to check with our legal counsel. But I do know that we set the beneficiaries, and what happens typically in these situations is your assets get sent to your beneficiaries, and the cost basis gets reset at that time, which is a very tax efficient way of doing it. I'll have to get back to you on an exact answer.
Okay. So turning to what maybe wasn't a competitor in your eyes 8 months ago, but has definitely been making a lot of noise in the space. So Strike has entered the Bitcoin-backed loan space, made a lot of noise. And they're doing this one thing that I found really interesting, and I'm curious if it's something that you all are thinking about, which is this idea that as Strike can offer up a slightly improved borrowing rate, they allow their clients to just refinance their existing loan right there to reset it at the lower rate. Is that something that Arch can practically do or provide? Do you
I'm
think it's an
pretty sure they,
exciting feature?
I'm pretty sure they copied that from us. We've had that for a long
Oh,
time.
really?
Yeah, so you can go in
Okay,
here
cool.
and click rollover. For them, you have to email them. With us, it's a one click in the dashboard. Our rates are going to match Strike. Actually, our rates are going to beat Strike in a few days' time.
Okay, cool.
So Strike's rates are dependent on loan size. I think the lowest rate goes down to 9.5 or 9.9%. And we're going to beat them on the rates across the different buckets of loan size.
Okay, very cool. Well, good to know. And then obviously, Strike entered this space, and now we're seeing a lot of regulations that are allowing for banks and other traditional institutions to get more involved in Bitcoin-backed loans as a potential category that they're going to find interesting. How do you think about making sure that, Arch remains differentiated, ahead of the curve? How do you just think about fending off that competition as it enters the market?
I actually don't think it's competition, it's more collaboration. So it's not trivial to set up a business like this. And in the US, there's still only 5 or 6 companies that offer this, which in the grand scheme of things is very little. Um, as these banks are coming in, we are, as far as I know at the moment, the only ones that actually offer our product out in a co-branded, a partnered manner, which is how we also work with Acropolis. Um, to another company that wants to offer lending, you can come to us, get set up in a day with a dashboard, with an admin dash on your side, with the capital. So you can literally start lending in a day, plug and play. Now, when banks come in, there's been a lot of conversations we've been having with some of the major banks in regards to partnerships because they want to offer this. They don't want to wait 2 years for a team to build it, and even then, uh, not build it well sometimes. Um, we can basically get them up and running in a very short amount of time and offer that value to their clients so they don't lose out to their competitors or to anyone else offering it. Now, there's obviously some larger institutions already doing this for the ultra high net worths, fully manual. It's not as easy to use as us, and it's obviously not accessible to most people. But with that technology and our systems, we can offer that at scale to anybody. So we've had a lot of these conversations with banks, and there's a lot of partnerships in the works where they want to get up and running, and we're the partner they're going to work.
Yeah, and an interesting way to hold the collateral that our teams are working on too, that hopefully we can share
Absolutely.
more about in the
Yeah,
coming months.
there's a lot of demand for that as well. Yeah.
Yeah. So, in the lending space, something that really excites me about the space is just the idea that Bitcoin gets increasing scarcity as solutions like Arch, reach scale, have these lower and lower borrowing rates. Because if you don't need to sell your Bitcoin and you can perpetually borrow against it forever, the scarcity just massively increases. And if the understanding amongst Bitcoin holders is there, then really it becomes a question of why would you ever sell your Bitcoin, and price just has to, run higher to try to find the marginal supply. That's what excites me about the market. But you obviously made a career of this with Arch and co-founded the business. What was it that attracted you to the lending space in particular early on?
Yeah, so it was a combination of personal needs. So in late 2021, my co-founder and my co-founder, he actually comes from a lending background. He used to do capital markets at Brex, which is a very large startup and small business lender. Um, we were doing a deep dive into basically all the lending opportunities in the market then. So we had the BlockFi's and Celsius of the world. Um, we saw that there's a lot of demand, but it was a lot of bad practices happening in the market at the time, taking like depositor capital on one side, lending it out the other side. You have duration mismatches as a result. Reapplication, especially not done safely. Very big lack of regulation. And I think that was a combination of the companies not really wanting to do it, and then also just lack of regulation in general, and just like not good practices in book management as well. So we saw this. We saw that credit in this space is still very small. For context, credit as a component of the asset class in real estate or public equities is 50% or more, often higher if you think of like the synthetic products on top of that. In Bitcoin, it's more like 1%. So there's a long, long way for us to grow, and it's a key pillar of any asset class. We haven't gotten there yet in Bitcoin, so it naturally made sense that that's the product we tackle first, and it is the hardest one to solve when you want to think about a full service private bank like experience for people that hold these assets. People have historically held stocks, bonds, real estate, some alternatives. In the past 15 years, that has changed to being, for a lot of people, being heavily weighted towards Bitcoin and crypto broadly. Those people are not served with the same level of products that you would be served at if you go to a UBS or JP Morgan private banking with your traditional assets. That's what we want to build here. We want to build something where you have the same level of comfort, peace of mind, and customer service that you get from one of these private banks. You get the interesting products that you have access to there, which we're now going to with all these niche lending-based use cases, and eventually with investing and such as well. We're going to allow you to do trades in just about 6 weeks or so. There's a lot of these things that you need to have a private banking like experience, which you will now be able to have with Arch. So it's a long-winded way of saying lending is the one that made the most sense to tackle first, and it's the one that I think there was the most to fix in and the most to innovate in. The market has caught up to that now, and I think us and a few other companies are doing that today relatively successfully, and I think we'll grow into this being even bigger. But now the time is to go into the more niche use cases, go into understanding where people are and understanding their journeys, and really providing that level of specificity that you would get from a traditional private bank.
Okay, yeah. And obviously Arch serves individuals, but also enterprises. So turning now to kind of the Bitcoin Treasury, corporate treasury use case of Bitcoin-backed loans, what are you seeing on that front with your enterprise clients? What's exciting? What use cases do you find interesting? And we'll kind of dive in from there.
Absolutely. So, as you've seen and you've built a business around this, a lot of companies are adopting Bitcoin treasuries, and it's not just uh, the big flashy ones that we see in the news. There's a lot of the whole long tail of these companies that have Bitcoin or are purchasing Bitcoin. Either it's founder led or it's a corporate decision, but they now have an asset base of Bitcoin in their treasury, and they want to utilize that to extract more out of it. So we see a huge movement in the kind of SME space where it's a few people in the company. These are solar companies, uh, irrigation companies, staffing companies, data center businesses, etc., that have Bitcoin on the balance sheet or in the treasury, and they want to borrow against that. Now, a lot of these are private, but there's also companies that are public that have Bitcoin. So we have a few of them as our clients, miners, ed tech companies, etc., that are public on Nasdaq or TSX or somewhere else, that have Bitcoin on the balance sheet, and they'd like to borrow against it for either it's like OPEX or CAPEX. A lot of these companies actually have somewhat negative market caps, like compared to their Bitcoin holdings. So their creditworthiness in the market as a public company is actually less than their creditworthiness as a Bitcoin company, because their Bitcoin asset value is actually often more or at par with like just their market cap, which is an inefficiency, but that means that their Bitcoin stack is something that lets them borrow more and efficiently versus their market cap as a public company. Now, these are these smaller treasuries. There are the bigger ones, and we're speaking to a number of them, just like you guys are, on lending to them, but they have additional ways of borrowing, right? So they can access like bigger public capital markets quite efficiently. So a lot of them, they're getting set up now their first stop is typically accessing those. Once they tap those out, then they're looking to access Bitcoin-backed loans. With the Bitcoin they purchase with the first tranche, they uh, are typically raising equity as well as debt, purchasing a large amount of Bitcoin. Now that they have that Bitcoin, they're looking to get additional utility from the Bitcoin that they have. So that is definitely catching up now, but we've already served a number of the smaller, call it sub 100 million market cap, like public.
And because Bitcoin-backed loans are an asset-based loan, not a credit-based loan, I guess the only difference on your end is licensing and KYB instead of state, local, national licensing and KYC.
Yeah, so lending in the US is regulated on a state-by-state basis for both consumers and businesses. So we're live in, I think around 40 states for consumers, 42 or 43 for businesses. We should be live in everything by the end of the year, including California, which is a big one. For businesses and individuals, there's not that much difference in terms of us lending to them, us managing the loan. It's all the same. We actually have role-based admins for different accounts. So if you have a business, you can have 4 or 5 employees with different Arch accounts and different like levels of access. And you obviously have KYB versus KYC. Again, it's fully automated in the platform, so you can come upload your documents that you need and get approved in most cases instantly. If it's a review, we'll approve you within a few hours.
And what is it about California that has, my state where I am, that has made it very difficult to get access to these types of lending platforms?
California regulators are unique. So you typically require a bunch of history in other states to even apply for a license, and it just is the longest time to get it. So it takes about 9 to 12 months to get a license. We've applied a number of months ago, so we expect to get it by the end of the year. And there are certain unique constraints with California where you have to prove that your customer has a certain amount of asset base or net worth to be able to even do a loan with you. So it requires some changes in how we do our loans, but it's not anything significant. So we should be live with them very soon.
Great. I want to be aware of your time, so I'm going to ask one more question, and then we'll kick it over to you for where listeners can follow your work and find Arch. But you've worked at really some amazing companies, a lot of big name companies that retail especially would be familiar with. So Snap, formerly Snapchat, Bird, Tinder, Amazon, and Microsoft. I'm really curious, which of those companies and your experiences working there has the most parallels with the company you're building at Arch today, and
So
why?
none of these were financial companies, but what they were, I think, were great examples of beautiful, simple consumer UX, and really trying to help a mass amount of consumers use something that at that time was the first of its kind or unique, right? So Tinder really led the charge for the second wave of dating apps. Bird led the charge for personal mobility in America, and Snap led the charge for very quick and efficient messaging of ephemeral pictures to people. So these all did something that were unique, and they all had very good examples of great consumer UX. What I've taken from all of these to our experience here, and it's not just me, I think everyone around the team has very strong, interesting backgrounds where they've learned really how to deal with consumers, how to provide them great experiences. In the world of Bitcoin and crypto broadly, we've not been used to great UX in the past. And for this to scale and get to the next billion people, we need very simple, great consumer UX. So what we've learned from there is people want things that are simple. They don't want things that are too technical. And they want things that have great customer service. And we provide all those things. And I think the proof is in the pudding. If you look at our Trustpilot reviews, they're almost all 5 stars, and people write essays about the experience. We've had people, our clients, invite us to their weddings, to different important events in their lives, just because they've had such a good experience with us. And I don't take that lightly. I think our customers are what we live and die by, and our customer always comes first no matter what.
Yeah, I think you're absolutely right, especially in an emerging space that is often very intimidating to non-technical folks, something like Bitcoin, crypto broadly. You really do need to focus on that UX UI design, give them a easy to understand interface, And honestly, those design rules, that world is really being built in real time today.
Yep.
And you all are doing a fantastic job with that on the kind of collateralized loan front. We're trying our best to do that for corporate Bitcoin Treasury, kind of a all-in-one platform for Bitcoin Treasury solutions and other financial services on top of your Bitcoin Treasury. So agree that that's really, what you have to lead with for the consumer experience. So if you've made it this far in the episode, I have to, ask for you to like, subscribe, and share as much as it's uncomfortable to do so. But please do, because this really has been a Bitcoin-backed loans masterclass with Himanshu here. But go ahead and tell folks where they can go to follow your work and find the company.
Thank you, James. First off, I appreciate you setting it up. I really hope people can use this as a reference point now or in the future to get educated about Bitcoin-backed loans. I think education is paramount in this space, especially when you're utilizing a high amount of assets to enter into any financial agreement, right? So this is super important. You can follow Arch online on X at Arch Lending. Our website is very simple, archlending.com. That's ARCHLENDING.com. My name is Himanshu Sahay. You can follow me on X as well at HHSAHAY, or just look me up on LinkedIn, Himanshu Sahay. As we mentioned earlier, we are an Acropolis partner, and we love working with everyone here. And I think as we grow and enter into more agreements with Acropolis companies, working with them, providing liquidity to them, I think there's going to be another version of this pod where we find even more use cases, and we'll come and do it again sometime.
Yeah, the use cases are kind of endless, and we're still uncovering them, especially in the new world of Bitcoin treasuries. So, Himanshu, thank you so much for your time today. I'll let you get back to building one of the coolest companies in the space. And everybody, please go follow him. Go check out Arch Lending. If you want to see firsthand what we're referring to when I talk about really great UI, UX, I mean, just go visit the website. It's a masterclass on its own front there. So thanks again, Himanshu, and we'll see you next time.
Thank you, Chase. Appreciate it.
Thanks for listening to this week's episode of the show. Don't forget to like, follow, subscribe, or leave a rating on your preferred podcast platform. One of the missions of Acropolis is to educate the public on the transformational benefits of Bitcoin and Bitcoin treasuries for companies. The more engagement we get, the more efficiently we can spread this message. Lastly, quick reminder that New Foundations is for informational and entertainment purposes only, and nothing should be construed as investment, financial, or legal advice. Companies interested in Acropolis can go to acropolistreasury.com to get in touch with our team.